So let's be honest, the reason why you clicked on this video is because you're unprofitable trading ICT concepts. You're left in the mix of nowhere. You don't know what model you should be trading because every single day you're getting taught a new model. One day you're looking at trading the I fully gap model, the next day you're looking at the unicorn model or the continuation model, and you're left stranded, not really knowing what you should actually be looking for whilst approaching price in the New York AM session. So today, inside of this video, we are breaking down the only model that you will need in order to be profitable trading ICT. I've simplified it to the point where there is a full step-by-step guide throughout the course of this video, which has generated me, as of 2024, just shy of 7 figures in payouts across multiple prop firms. Also taking multiple students to a level of consistent payouts. As recently, I took on a student, which his name is Danny from New York. He got paid out $28,000 across his 5 top step accounts, which was around 5.6K submitted as a payout in each 5 of his accounts. Another example would be my student Marvin, who got funded recently 550K top step accounts, which is now further scaled up with being up over 2.5K on each account, therefore up about $12,000. He also has his take profit trader accounts, which he's now actually scaled them up and just submitted a 3K payout, which I'll pop up on this screen as well. And I myself have just submitted a $50,000 top step payout, which I received a few days ago prior to making this video, which I'll pop up on the screen again. So the proof is there, you guys can see it, but the problem is the execution, finding the model. Which model should I be trading? Well, the only model that you do need is the unicorn model inside of the New York AM session. And you're probably sat there thinking, what is the unicorn model? What is the win rate? How consistent is this model? Can I rely for this model to be my full-time income? Can I rely on this model month by month to produce a consistent win rate all year round? Of course, there's many questions going through your head whilst you're watching this video, which are all going to get answered to the T. So without wasting any of you guys' time, let's dive straight into this video, break down this model to the point where you'll come out the end of this video with a complete understanding from determining your bias to actually executing and identifying the model in real-time price action. So let's get straight into this video. And you're probably thinking, Milo, if you're getting so many payouts, why are you taking on people for one-to-one coaching? The reason is because I'm taking on a minimal amount of people in order so they receive the maximum gain potential out of the one-to-one mentorship. I've only taken on 4 students so far, and 2 of them already have been paid out. One of them, $28,000. The other one just got paid out yesterday by Take Profit Trader. Full screen recording of the messages as well inside of this video, as you've seen, $3,000. He's up a further $12,000 on Top Step, which he's about to get paid out 50% of that, which would estimate to around $6,000 to $7,000. And you're probably thinking, why am I doing this? To prove to you guys that not only I can trade this model and get paid out consistently, but so can you guys as well. If the one-to-one mentorship was a position for me to make money, then I'll be taking on hundreds and hundreds of students, which I'm not. So far, I've taken on 4 students. I'm looking for 2 more potential students that are currently struggling with ICT concepts, whether you have a vast amount of knowledge or a little amount of knowledge to do with ICT. I'm going to bring you from the point of being unprofitable to profitable, getting paid out on a consistent basis, and actually scaling up your accounts. Of course, many people apply, thousands in fact, but only a few will actually get accepted. The ones who are dedicated, the ones who actually are committed to the process in order to achieve the end goal. Along with the end goal, whether you're down to do it or not, you also get flown out to come meet me in person, which I'll come pick you up and we'll go on a little trip. Just like my student Danny, who I booked him a flight from New York to Miami. We spent a day together. It's on this YouTube channel. He got paid out $28,000 and I flew him out. I also have another student, Marvin, who just got paid out, and I'm also going to go meet him in the US in a few days. As you guys can see, I'm currently out in Colombia. Why? Because I put the Rolls-Royce Cullinan into the garage for many, many upgrades. So I didn't have a car for 10 days. So I thought, I need to get some Latinas, and I need to free my mind a little bit. So I came to Colombia for a few days, and I'm going to go back to Miami in 3 to 4 days. So if you are 100% interested in taking your ICT trading to the next level and becoming consistently profitable, therefore receiving consistent payouts, then in the description of this video, there is only one link for the form to apply for the one-to-one mentorship. And with that to the side, now let's get back into the video, going over the only model that you need in order to be profitable with trading ICT concept. Let's get straight into the video. Okay, so now let's dive into the core content of this video inside of this PowerPoint. I've put together an absolute masterpiece, simplifying down the unicorn model to a T, so every single one of you guys watching this video will understand it and come out the end of this video with a complete understanding exactly what you should be looking for in order to enter a trade. Turning knowledge into profit, along with patience. You can have all the knowledge in the world to do with entering on any model. Doesn't have to be the unicorn model, could be different concepts in itself. If you don't have the patience in order to wait for the model to present itself, you're never actually going to succeed in this business. Many of you guys, or some of you guys, treat trading as more of a get-rich-quick scheme, where you approach price thinking that today is the only day I can make money, today's the day that I'm going to get paid out or funded. This is not the way that a business should ever be treated. It doesn't matter what business you are running. This is a business that if the rules are not followed correctly, you're never going to be profitable by any means. And along with following the rules, the model only presents itself around 1 to 5 times a week. It varies massively from a week-to-week basis, that one week you may be taking 3 to 4 trades, and then the following week you may only take 1 trade. And of course, money flows to those who are actually patient in waiting for the model to present itself. You need to be a master of your own emotions and understand that if the models apply correctly, then you're actually going to become consistently profitable by using this model. What does the model consist of? Before we actually get into the model itself, the unicorn model, you actually need to determine your daily bias. So the first thing you do at the start of each day is determine your daily bias by starting on the daily time frame and then working out a result, either bullish, bearish, or neutral for each time frame. We don't look at all different time frames scattered all over the place. Every single day I have the same structured approach that I follow each day. I don't use mitigation blocks, order blocks, breaker blocks, fair value gaps, sweeps liquidity. Are we above or below the New York open price? Are we above or below the midnight open price? Before you know it, you're going to be sat in your chair sweating and not really knowing how to determine your bias at all, because there's always going to be something going against something and you don't really have a structured approach on how you can determine your bias. So the way that we actually determine bias specifically, which is the most effective and simplistic way that you can possibly determine bias, is by looking and starting on a daily time frame and understanding what imbalance are we currently in. Is it bullish, bearish, or nothing? If you're in a bullish fair value gap, we assume a fair value gap is respected unless it gets inversed / disrespected. The candle must actually close outside of the fair value gap in order to confirm an inverse. If we don't inverse the fair value gap, we assume the fair value gap is respected and take that to be our bias. Our bias is going to be bullish out of a daily bullish gap on that time frame towards the next bearish imbalance or the next daily high. Then if that's your bias, then you go down to the 4-hour time frame. You don't include what you've seen on other time frames. You only look on each time frame and you get a result. You're like a site surveyor who walks onto a building site with a checklist and you're ticking off each time frame. You get a set of results and then you look at each result. It's going to be bullish, bearish, bullish, bullish, bullish. Then you're leaning towards a overall bullish bias. Then you head over to the 4-hour time frame. Are we currently in a 4-hour bullish or bearish gap, or maybe we're not inside of a gap at all? If we're trading out of a bullish gap from the most recent candle, then the draw is going to be the next high on the 4-hour time frame towards either the next high or unfilled or filled 4-hour bearish imbalances. It's very important when you do determine a bias. Too many people would take a bullish bias from the New York Open and still be running the same bias inside of the New York lunch or even the New York PM session. This is the complete wrong way to have your bias, and you must be re-evaluating your bias as price tends to move quite aggressively at the New York Open and we go ahead and take out buy side and sell side liquidity. That's when you actually need to re-evaluate your bias. Okay, I was bullish until a certain point. Where are you bullish to? Okay, is that London highs? Now we've swept London highs, we're tapping into higher time frame bearish PDRAs / imbalances. Now our bias we re-evaluate, so we look on the daily, we get a result. Okay, now we're in a daily bearish gap. Now we're in a 4-hour bearish gap. We're in an hourly bullish gap, but we're in a 15-minute bearish gap and a 5-minute bearish gap. Then now we're leaning towards an 80% 4 out of 5 bearish bias. This is how we determine bias effectively. So once you have your bias from determining purely off imbalances without anything else, we don't look at sweeps liquidity until we actually look for the trade. We determine our bias separately, then we look for a sweep of liquidity following our bias. Obviously, if you have a bullish bias, you'd be preferred to see a sweep of liquidity in a discount such as London lows, Asia lows, data lows, previous day low, previous week low, etc. As you guys already know, there's many sweeps of liquidity that you can have. So along with your bias, you then look for the model, you execute it. You're either going to make money or you're going to lose money. And repeat the model enough times. It's all about the thought process. It's not about the end result of the trade. We don't care where you end up after that day or that week. However, at the end of each month, it's good to reevaluate how many handles did I close up, down, or maybe you're neutral on the month, maybe you're break even on the month. We don't look at a daily result because there's going to be plenty of days that you close out in the red. There's going to be plenty of days you close out in the green. At the end of the day, it's not about the end result and dollar amount for the trade, it's about the thought process of the trade you take. As long as you have the correct thought process following the same model each day, then you are going to close out majority of months and weeks and days in a profit of that year. When it comes to consistency over the course of the whole year, I personally aim for about 10 to 11 out of 12 months of the year to close out in a green. Last year of 2024, I closed November, which was my only month that I closed in a loss, of around 27 to 30 handle loss, which for me equivalates to just one losing trade of November. This, for psychology, for many people, is going to throw them off, and they are going to sit there thinking, I've not made any money this month. How is the model still working? Am I trading the model right? And they start to have doubts. They think they're not profitable anymore. Little do they know, next month is going to give them a very, very good month. Or maybe it'll be another break-even month, which is very, very rare. The model that we trade is based off a win rate of around 63 to 65%, which varies from month to month. Some months you may have an 85 or 90% win rate on a very, very crazy month. On another month, your win rate may go down as low as around 40% or 45%. Over the course of a whole year, which I like to look at myself, of data of the trades I have taken over the past 2 years, from 2023 to 2024, that's the data I have for my trades, I'm currently sitting at around a 63% win rate with a 2-to-1 risk to reward. I'm not aiming for anything crazy like a 5-to-1, a 6-to-1, a 7-to-1 risk to reward like some people show on Instagram on FX Replay. I'm only looking for a 2-to-1. I don't care if I take a trade and it's a short to target, say, the overall draw to be London lows. I'm only looking for a 2-to-1. London lows would usually be, say, a 3-to-1 or a 4-to-1, 5-to-1, etc. I'm specifically targeting a 2-to-1 to be the first 1 minute low that I can look to target in that short position, and I'm closing out fully for a 2-to-1. I don't care if there is a very strong draw for equal or London lows. I'm specifically targeting the first 1 minute low that gives me a 2-to-1. In a long position, the first 1 minute high that gives me a 2-to-1 risk to reward. For each trade, depending on your funded account or your live account, you should be risking the same dollar amount. I have a set max risk of 30 handles on NQ risk per trade and a set dollar amount risk per account per trade. So for example, if you're on a 50k funded account with TopStep, you've got a 2k drawdown. Therefore, I recommend that you're actually trading with 6 micros, which equivalates to around a $350 risk with a 30 handle stop. 30 times 2 times 6 is going to equivalate to around $380 to $350, around that range. So for example, if you take a trade with a 30 handle stop, yes, you're risking the correct amount on how much you should risk per trade. If you risk, say, using 15 handle stop, you're only risking around $150 to $180 on that trade. Therefore, your position size on a trade that you take with a 15 or 16 handle stop, you should then double or increase your position size by a percentage, which equivalates up to the same dollar amount of 30 handles. So if you're risking 15 handles, technically you should double your position size from 6 and take that trade with 12 micros. Therefore, when you aim for a 2-to-1, you're always going to lose around $350 to $380 a trade, and you're always going to make $700 to $800 per trade. Obviously, it's going to vary in the risk to reward because some trades you may take a 1.8 risk to reward, which is my minimum, and some trades you may be forced to have to take a 3-to-1 risk to reward where you're actually going to make, say, 1.2k on that trade. So going back to determining bias, we only determine our bias from the most recent imbalance. We assume a fair value gap is respected unless it is inversed. Hopefully you guys understand that, and I want you guys to actually use this on your next backtesting session to determine bias, and let me know in the comments of this video on how effective it actually was instead of actually using every PD array to do with ICT. And what you will find is going to give you a way higher success rate in determining bias this way than the ways that you may have previously determined bias. So now, inside of the next slide, we're going to go over one of the most crucial things to do with trading this model is session timings. We have 3 sessions: London, New York, and Asia. So these 3 sessions, in particular, we only trade one of the sessions, which is New York, and specifically the New York AM session. Inside of that, we only trade the first 3 AM macros. So the 3 macros that I specifically trade is 9:45 AM to 10:15, which is the first AM macro. The second AM macro, which is at 10:45 AM to 11:15 AM. The third macro, which is at 11:45 AM to 12:15 PM, which is the start and going into the lunch macro there. Each macro presents itself with different types of opportunities. The first AM macro may present itself with a power 3/Judas swing at the New York Open, and then inside of the lunch macro, potentially you would see a run on stops from the AM session, maybe had a run up or a run down, and inside of the lunch macro, price tends to have a run on buy stops or sell stops to come back to a premium or a discount which was created inside of the New York AM session. Not always. Sometimes inside of the lunch, it may just be a normal trade from price coming from a discount to a premium and not actually seeking discount or premium for that trade. So we start by trading the New York session inside of these 3 macros, 1 winning trade per day. Let's say ES took the low, you was targeting for 50 handles short on NQ towards the low, but ES took the low, therefore you had to close out the trade prematurely. You only secured 25 points, therefore you're probably up not as much as you believed you would have been on that day, but you had to close out as the trade was no longer valid. SMT at the low for ES taking the low. It doesn't matter. It does not matter at all. Even if you secure a small dollar amount or a big dollar amount on the day, after 1 winning trade, you close your laptop and you're done. If the first trade is a losing trade, you do not take another trade inside of the same macro. You wait for the next macro out of these 3 and you see, does price present a clean opportunity inside of the next macro? Yes, no. Well, if it's no, then no trades. Yes, go ahead and take it. If the next trade is a loss as well, so 2 losses in a day is going to stop you from trading. The same as 1 winning trade. You're going to be done for the day. If you're not satisfied by the amount of money made from 1 winning trade, then you simply don't have enough capital, and it's actually time to scale up by looking at softwares such as TradeSyncer or Replicanto to group multiple funded accounts together and also start scaling up your live account as well. Understanding the actual model we trade, which is the unicorn model, for a simple step-by-step guide to deter the difference between A+ and a B+ setup. An A+ setup I take with full position size. Depending on the account size, drawdown and balance, the position size is going to vary. And then for a B+ setup, I take it with half position size. So getting into this slide, the first thing that we want to identify, as we spoke previously, is our bias. With our bias, we then want to see a sweep of liquidity following our bias. With a bullish bias, a sweep of sell side, and a bearish bias, a sweep of buy side. Then once you have determined those 2 things, you now want to actually identify the model itself, which is clearly labeled out from number 3 to number 8. Number 1 is bias, number 2 is sweep liquidity, number 3 is a fair value gap on both NQ and ES. Another thing that you must see is a displacement on both NQ and ES, a body candle closure below the previous short-term low or high, depending if it's a long or a short position, is what you want to see in order for the trade to be a valid displacement on both NQ and ES. Then along with the displacement, of course, a fair value gap on both NQ and ES, which is paired with a breaker or a mitigation block, but it doesn't have to be paired on both NQ and ES. You can have a breaker or a mitigation block paired with a fair value gap on only ES, but not on NQ. As long as you have it on either pair, then it's fine. Then you've ticked number 4 off. Then going against the 5 and 15 minute rule. What does that mean? So if I'm looking for a short position, if we're inside of a 5 or a 15 minute bullish fair value gap, which is technically going against the trade, then that's automatically going to make it a B+ setup. 5 and 6, you can avoid only one. You can either avoid 5 or you can avoid 6. You can't avoid both. 1, 2, 3, 4, 7 and 8, you can't avoid these. These are essential for the trade to be valid. You can only avoid either 5 or 6. And when I say you can avoid 6, occasionally what happens, you must have a displacement on at least one of the pairs. Either NQ has a shift in market structure, but not on ES. However, you have everything else to do with the trade in place, but one of the pairs has displaced, but the other one is lacking behind just a little bit. Therefore, you can still take the trade as long as you have everything else in with the trade, but it'll be B+ and it'll be taken with half size. Then an SMT, a lot of people glamorize an SMT. Yes, it's a confluence and it's going to be early signs that you are going to get a model at that place. But an SMT is only a confluence to a trade. It's not going to be a requirement for a trade at all. Okay, so now you guys have more of an understanding to do with the model that we do trade. Let's dive into the next slide, and I'm also going to show you guys a full back-tested example of trades that I've taken myself over the past couple weeks, putting our knowledge to the test. This slide is very, very simple and there's not really much going to it. However, I put this photo here because there is steps in order for you to go from where you're at now to the point where you want to be. And trying to take huge leaps up, what I mean by that, you trying to pass your funded account in one day, you trying to receive a payout this week because you need it so bad so you can prove to other people that you're getting paid out. You're going to get paid out, but it's going to be a longer time span of say 2 to 4 weeks once you get funded, of say 3 to 6 weeks after you get funded. That's when you can start to near towards a payout, not within 1 week. Otherwise, if you did, because you're using too high of leverage, taking too many irrelevant trades, and therefore if you was to get to the point of payout, it would be based more on luck than actually having an actual structured profitable strategy that you have in place that you're following. The trader who takes the little steps will compound way faster and way quicker over time than the trader who takes a massive step each time and tries to be very impulsive with the decisions that he makes. weeks. This is a business that you need to be relaxed, structured, knowledgeable, and then applying it correctly. Without that, you're going to end up like this guy who tries to make massive steps and really sees no consistent progress by a week-to-week basis. Yes, the trades are unpredictable, whether you're going to win or lose your next trade, but as the weeks go by, you're going to progress and scale up over time. But by making impulsive decisions, it is only slowing you down. The person who makes the right decisions is on a natural growth as time passes. So now it's time to actually dive into the charts, and let's actually show you guys examples of trades I've taken over the past couple of weeks, which will help resonate with you guys behind this YouTube video to understand more deep into my thought process with the trades that I have taken myself. Okay, so diving into price, where you guys can see I'm on the daily time frame and I'm looking to determine my bias. So by looking at the daily time frame, what imbalance are we currently in order to determine a bias, or maybe we have a neutral bias. So let's take a look. So as you guys can see here on the daily time frame, we was in a daily bearish imbalance where we assume a fair value gap is respected until it's disrespected. In this case, it got disrespected on this day where it got inversed. Price has then traded back into the I fair value gap. If I zoom in a little bit more, you guys will be able to see more of a clearer view of this I fair value gap. We inverse the upper daily bearish fair value gap. Price reaches back into the daily I fair value gap below, then trades higher. Trading out of the I fair value gap, the draw is going to be to where? The next daily swing high on that time frame that was created. We've taken out that swing high. We've then traded into no imbalance. We're not inside of a daily bullish or a bearish imbalance. Therefore, we're simply going to write down on our screen as 1 day neutral. Now we're going to take over to the 4-hour time frame, understand what imbalance are we currently in order to determine our bias. So by looking at the 4-hour time frame, you can see we're currently in a 4-hour bullish fair value gap and also a 4-hour bearish fair value gap. So if you take a closer look, the draw out of the bearish fair value gap is going to be the next low, you can see there, and then the draw out of the bullish gap is going to be the next high. So what you can see for price is that we traded out of the 4-hour bearish gap on the candle previously. We took out the low, so we met the draw for the 4-hour bearish gap. As of now, this candle is not inside of that bearish gap. Therefore, we're going to take a bullish bias on the 4-hour upwards towards the bearish gap and an overall draw for the high. So now we can write down 4-hour bullish. Now we're going to take a look at the hourly time frame and understand the overall draw for the hourly time frame. So marking out the imbalances on this time frame, and you can delete whatever you've done on the other time frames because you don't want to take that into consideration for each specific time frame, which is its own thing in itself, where you determine bias specifically for each time frame. So by marking out this hourly bearish gap, which is very obvious in front of us, also marking out this hourly bullish hourly gap, you can see what is the most recent imbalance we've traded into. So we traded into this bearish imbalance, therefore the draw is going to be the next hourly low. We then swept the next hourly low, trading into what? The hourly bullish fair value gap. Price trades into the hourly bullish fair value gap, then takes out the low. The draw, as of now, is going to be the next hourly high and also the hourly bearish fair value gap. So we are now going to take a bullish bias out of the hourly bullish gap. Now we're going to look at the 15-minute time frame. On the 15-minute, we do two things. We understand the next 15-minute draw, and then we also mark out the key levels on the 15-minute time frame on both NQ and ES, which is going to include London highs, Asia, data, previous day high, and also new week and new day opening gaps. So by looking at the 15-minute time frame as of now, you can see that we traded out of a 15-minute bearish fair value gap for the draw to be the next 15-minute low. The 15-minute low, then the draw got met for the bearish fair value gap. Okay, then price trades into a 15-minute bullish fair value gap. So we swept the low of the 15-minute bearish fair value gap, tapping into a 15-minute bullish fair value gap for a draw now to be the next 15-minute bearish fair value gap or the next high, which in this case the draw is going to be this 15-minute bearish gap and the high on the 15-minute, which is going to lean towards a 15-minute bullish bias. You can already start to see we're developing a strong bullish bias. So now also on the 15-minute time frame, along by creating your overall bias, you also want to mark out the key levels. So as of now, you guys can clearly see between 2 AM and 5 AM, that is going to be London highs. So we have a clean set of London highs and obvious lows and highs you want to mark out, such as this low. It's a non-time based low, but it's an obvious low that price would want to take out at a specific point. And then whatever you mark out on NQ, make sure to mark that out on also ES as well. And then because above this previous high, we actually have a 1 hour bearish gap, which is below London highs, I'm going to mark this previous high out, which is a more recent high, as minor buy side liquidity. And then we can copy and paste that over to ES as well. The reason why we do that is because we look for potential SMTs and differences between the two pairs, which can favor us in a trade that we actually take. So now we're going to drop down to the 5-minute time frame and understand the draw. You can see we was trading out of a 5-minute bullish fair value gap to the left, which is now traded into a 5-minute bearish gap, which is the only gap we're currently in. Therefore, the 5-minute is going to result as bearish. So our overall bias out of 5 results is going to lean 3 out of 5 bullish. Therefore, we have a 60% bullish bias. Therefore, your bias is going to be bullish. Now, we're going to drop down to the 1-minute time frame and monitor price upwards to the first day macro and see what happens at the New York Open. This point of minor buy side that I actually marked out is going to actually be data highs, which was the news which came out at 8:30 a.m. So data highs and data lows is going to be an overall major draw for price. If you guys were trading the June contract on this day of June 17th, the news that came out at 8:30 actually created a lower data lows than this low you can see here. So we had a clean set of data lows that hadn't already been swept on June contract. But many of you trading on Top Step X or the Tradeovate platform would have had auto roll contracts, and you would be trading the September contract and would have seen this same chart, which you can see here. I was actually still on the June contract, as I hadn't already auto rolled on TradingView to change the contract from June to September. Obviously, as of now, we have a way higher open interest and the June contract's expired. Of course, now I'm on the NQU 2025 contract, which is September. So let's fast forward price. As price takes key levels, you want to reevaluate your bias, of course. Okay, so what we've actually seen here at the New York Open is a Judas swing. Price has gone immediately for data highs and then traded back to the New York Open price, which you can see here. So we've swept data highs with our overall bullish bias being the overall draw for price. We've swept data highs prior to the first day macro at 9:45 a.m. Now price has come back towards minor sell side and swept minor sell side. So going into this first day macro, we actually want to determine our bias again. As we've taken out key levels, obviously our bias is going to potentially shift. So at the same current low that we've just swept on NQ, I want you guys to notice the difference between NQ and ES at this point, which is now going to lead to a bullish SMT on ES, as ES is the stronger pair out of the two, which is now a confluence for taking longs on NQ, considering that we have a bias and a strong draw higher. As of now, you can clearly see that we do have a draw for London highs as the overall draw for price. We can move our minor buy side to the more recent high, and then now identify our overall bias once again. So on the daily time frame, not much has actually changed, and we're still going to take a neutral bias as of now. On the 4-hour time frame, not much has changed at all. We're still not inside of the 4-hour bearish gap, as you can see there. We're inside of the bullish gap, so the 4-hour is bullish. The hourly is currently bullish as well, because we haven't met the draw for London highs. Neither have we traded into the hourly bearish gap. Therefore, the draw is higher. So it's bullish, bullish, and neutral on the 15-minute time frame. As you can see here, the bias is going to be bearish on the 15-minute, as we've inversed the 15-minute bullish fair value gap. So the draw is going to be that point at sell side. Also trading out of that bearish gap as well, leading us to a bullish, bullish, and 1 bearish. So we are 2 out of 3 results as a bullish bias as of now. And then looking on the 5-minute time frame, you can clearly see we've traded into a 5-minute bullish fair value gap to the left. Therefore, our 5-minute bias is bullish. So 3 bullish, 1 bearish, and 1 neutral. Overall bias is going to be bullish here. So now we're going to look for longs inside of the first day macro. Let's fast forward price. Okay, so price creates a short-term high. Now we're going to look for a shift in market structure above that high. Okay, price has presented a fair value gap, a mitigation block on ES paired with the fair value gap, which you guys can see there. The overall draw is going to be London highs, and we have a fair value gap on both, a displacement on both. Are we going against the 5 and 15-minute draw? Well, let's check. On the 5-minute time frame, we're not inside a 5-minute bearish gap going against our long position. And on the 15-minute time frame, you can see that we actually have traded into the 15-minute bearish gap, which is going against our trade. Therefore, this is going to be a B+ trade that I took myself with half position size. Now we're going to look for an entry, considering you can see it's inside of macro, off the first presented fair value gap, and then we're going to take an entry off here. We're going to run our stop placement at the body candle low and target the first high that gives us a 2 to 1, which you guys can see here. This high is giving us a 1.9 risk to reward, which our minimum is a 1.8. Therefore, we will take this trade if we get an entry. Okay, that is our entry for price, and then as price nears and takes out this short-term high, that's when we can actually go towards break even for the trade. Okay, so as you guys can see there, in the space of 30 seconds, my TP got absolutely obliterated. I didn't even have time to go to break even for this trade. This candle opened and went straight towards that point of minor buy side that we had marked out, and also took London highs on ES as well as the overall draw. That was the trade that I took on the 17th, and because we're only risking 20 handles on this trade, therefore you can increase your position size by 10 handles equivalent. Therefore, if you take it usually with 10 micros, you can then take it with around 15 micros in order to relate the same dollar amount as a 30 handle stop. Therefore, you would actually make the same amount of money because you're just aiming for a 2 to 1. Your 2 to 1 should be from dollar amount to dollar amount, not from handles to handles. Our max handle stop placement is 30 handles, therefore you're aiming for 60, but each trade you should always be risking around $350 a trade for a 50k account example, aiming for $700 per trade. Not because you're risking less handles on one trade, you're only risking 200 on this trade. Every dollar amount per trade should be the same. Your handles is going to vary, therefore your position size will actually vary as well. Okay, so now we've gone over the first example. I'm going to show you guys one more example as well of a trade that I took over the past couple of weeks as well. So let's get straight into it. Okay, so this is not a trade that I took personally. I was in Miami airport flying to Colombia at the time. I dropped the Rolls Royce in the garage. It's currently away for another further 3 days. It's getting a wrap, new wheels, and a forged carbon hood fitted to the car as well. It's going to look insane. So I thought I need to go somewhere whilst I don't have a car. Therefore, I flew to Colombia to see what it's saying. Whilst I was in the airport, an absolute A+ setup formed. I was going through security at the time of the displacement. By the time I got out the other side of security, I'm pulling out the laptop out of my bag. I can see the trade. Everything's a bit rushed. I can't get on to actually group trade all of my accounts together. I would have only been able to take it on the live account. Everything felt a little bit rushed, so I decided to skip the trade. I watched it play out. It was A+. That's how it is sometimes, and I should have chose a flight outside of macro times. So it was my fault at the end of the day. For this trade, I'm going to show you guys, which is a very, very clean setup, formed on Friday, 20th of June. Starting on the daily time frame, once again, let's determine our overall bias. So by looking at that inverse fair value gap, which you guys can see here, on this current day, we have traded down into the inverse fair value gap. Therefore, the bias is going to be bullish towards the next daily high, which in this case will be this one. Okay, so now we've come on to the 4-hour time frame. Let's determine our overall bias here. You guys can see that we're currently trading out of a 4-hour bearish fair value gap. So our bias is bearish. The way we determine bias is a lot more simpler, and a lot of you are starting to get very relieved because the way you was determining bias before was extremely overcomplicated for no reason at all. So the daily is bullish, the 4-hour is bearish. As you guys know, that's 50-50, so we're neutral. We don't have a clue where price is going to go. So now we're going to look at the hourly time frame and see what imbalance are we currently in. Well, similar to the 4-hour, I can see to the left, we're currently inside of a hourly bearish fair value gap to the left. Therefore, our hourly bias is going to be bearish. Now let's look at the 15-minute. On the 15-minute, we're not in a bullish gap. If we have a look to the left, you can also see we're inside of that 15-minute bearish fair value gap. If we zoom to the right, you can see price is still inside of there. So our 15-minute bias is actually going to be bearish. Now on the 5-minute time frame, you can currently see there is going to be a 5-minute bearish gap to the left, which is a little bit difficult to actually zoom in, but you guys can see that we're currently inside of a 5-minute bearish fair value gap. So the bias on the 5-minute as well was also bearish. So you can clearly see we do have a very strong bearish bias. 4 out of 5, 80% bearish bias here. So now we're going to mark out any key levels that we want to look at on this specific day. On this day, I was looking at the high created on Wednesday. It's currently Friday. So I marked out this high to be a major point of buy side liquidity. Our overall bias is bearish. Therefore, we have a bearish bias, a sweep of liquidity, and I want you guys to identify the difference between that high on NQ and ES. So if I mark out the same high on ES as well, which is going to be this high here, you can clearly see that we do actually have a SMT as of now in place at Wednesday's high. So that's a confluence so far going into this first day of macro. We're currently at 9:43 a.m. and we're anticipating a shift in market structure. We've taken out minor buy side liquidity on the lower time frame, higher time frame bearish SMT. Let's fast forward price as we go into this macro to see whether we get any opportunities to look for shorts. Okay, as you guys can see here, we've seen a shift in market structure below the previous short-term low. We have a clean draw. This is the New York Open candle. Therefore, the New York Open low that was created by price, and we're going to copy this over to ES as well, as we also have a clean New York Open low. So we've seen a displacement on both NQ and ES. We have a fair value gap on both NQ and ES. We have an SMT as a confluence, a sweep of liquidity following our bias, which we've already determined. Now we want to check the 5-minute time frame. We're not inside of a 5-minute bullish gap going against the trade, so that's fine. We're not inside of a 15-minute bullish gap going against the trade, so that's fine as well. We can tick that one off. Inside of macro, yes, valid stop placement. Well, let's take a look. So we're going to look for a short of the first presented fair value gap, you guys can see here. Running a stop placement at the breakaway gap, because this candle caused a displacement and created a gap as well. We can run our stop placement at the breakaway gap's high, so around 22.75 handles, and then targeting the opposing liquidity for the first 1-minute swing low for price, which gives us a 2.7 risk to reward. Let's fast forward price and see if we get an entry. Okay, so as you guys can see here, the next candle has opened and ES has created a lower resting fair value gap. So if either NQ or ES trades into a fair value gap, then we enter on the trade, considering that we have a valid stop placement. So one rule is that if ES taps the fair value gap for NQ, I'm going to enter on NQ straight away, as long as I have a valid stop placement. Okay, so as you guys can see, the next candle opened, we traded up into that fair value gap. Therefore, our entry for price would have been just a little bit lower as of this point here, and call an entry short on NQ off this bearish fair value gap on ES. As soon as ES taps it, we would be in. We're running a 30 handle stop and we're getting a 1.81 risk to reward. This setup would be taken with full position size, as it's completely A+, and we're looking to target the New York Open low. So once that's taken on either NQ or ES, then we're going to close out of that trade. And there you have it. That candle there on ES has taken the New York Open low. Therefore, you're going to close out of this trade fully on NQ for around a 48.25 handle gain. So once again, another very successful week. Therefore, and hence why I'm receiving so many payouts at the moment with multiple prop firms, including my live account as well, that I show you guys screenshots of payouts that I've received from both funded accounts and also my live account as well. In fact, after this video, I'm actually going to deposit even more money back into my live account to scale it up even more from the payout that I've just received. If you guys have found this video useful, make sure to run up the likes on this video. It would mean a lot. And subscribe to this channel, as you may not actually see my face again on YouTube. And for future videos on this channel, any topics that you guys are not really that familiar with and you want me to go over, make sure to drop a comment for future related videos or questions just about myself, or for questions about general life in itself. And until the next one, I'll speak to you guys shortly. Have a great rest of your day.